The market has recovered very nicely despite everything going on, but not every sector has done quite as well. And we're going to focus with Professor Mark Guthner today on one of the sectors that hadn't rebounded completely, but might be turning the corner. Today on Office Hours. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guthner of Rutgers University. Mark, how are you, my friend?
I am terrific. 2 more weeks to go. And
And
the
then
school,
summer vacation, eh?
yeah, then summer is here. I got a ton of work to do over the summer, but that's okay. It'd be nice to be doing a different kind of work.
Yeah, I imagine.
The one,
There's probably going to be a little brief period, I imagine, after you give your final exams where people come knocking on the door to complain
yeah,
and
negotiate
say,
grades. There's a big sign on my wall. I do not negotiate grades. So,
oh,
yeah,
really?
I tried to cut that one off nip that one in the bud, as they say.
Right,
Because
right.
I don't need it. And the one thing that does happen at the end of every school year, kind of starts around the spring break time period, is I just get really tired of listening to myself talk. Because
I never tire of that.
I lecture, whatever a number of hours that is every week, and at some point it's just like I get tired of my own voice,
Mm.
um, and stuff like that. So
I have watched recently one of the byproducts of doing this kind of thing. You know, you and I have, we're not media people per se. I mean, I show up on CNBC and we've done these live streams, but, we're not experts on this kind of stuff necessarily. So you put a camera in your office and you try to get some lights going and,
mhm.
you know,
Oh,
tinker with microphones and all that kind of stuff.
it reminds me, I
Um,
forgot to turn my light on.
oh, all right. One of the things that this has done is that it has meant that I actually am not just a content creator. We're not just content creators, but I am also in the audience. So for this is a big thing.
Yeah.
There's a lot of YouTubers out there who talk about, oh, do you want to start a podcast? Oh, do you have cameras? What kind of cameras do you have, and how do you make them work, and things like that. And one of the things that I have observed recently is that a lot of the content creators that I have historically watched on YouTube, many seem to be coming out now and saying, I'm done, or I'm retiring, or I'm making a big pivot. Now, I think this is because, and I don't know for sure why this is so, but you and I don't make any money from doing these videos. We don't make money from ad sales. We don't promote any products per se. We do this basically to sort of keep the conversation fresh and ongoing and things like that. Uh, but I have observed that some of these people, maybe they've tired of their own voices, or maybe the economics for going on to things like YouTube has changed. I don't know if that's true, and it does make me wonder. X is privately held now. YouTube obviously is part of Alphabet, but I wonder, do you think that the economics of the business are changing, and that's going to have an impact on some of these
Well,
companies?
I think it's getting certainly more crowded. One of the things that I noticed is people doing more things. And the one thing that I've been really intrigued at, I started watching a bunch of videos, and I noticed something. AI is doing something that's really clever. So somebody has taken a picture of John Bogle and John Bogle's voice, from Vanguard,
Hmm.
and he talks about various important investment issues. And of course, he's no longer with us. And so but they are so well done. And then I've listened to a few others, and I'm going like, this doesn't feel live, but it is doggone close to live. And So I think that's having a little bit of an effect. I think if you were trying to do this thinking that you're going to become Joe Rogan, you're in deep trouble because at the surface is just too crowded. And you and
Mm.
I have both talked at the Money Show, for example.
Mm-hmm.
Um, and there's a lot of people that do that, and they sell their wares there, and you can tell that they don't really have the pedigree. Some of them don't have the pedigree to, like, deserve to get people's um, money in terms of subscription money, stuff like that, because that's what a lot of those folks are there for, right? Let me know. They go and talk about whatever their investment theme is, subscribe to my newsletter and stuff like that. Nothing wrong with that. It's advertising and education. Um, I've gotten comments a couple of times at that, and he says at the end that there's something wrong with your presentation. I go, like, what's that? And he says, you don't try to sell us anything. And I said, I just want you to be a little bit smarter, and making decisions. And if you want to subscribe, I did tell you, I have a place you can subscribe, to the Options Edge, but I'm not going to give you the hard sell. Um, my idea is that yeah, make you a little bit smarter and a little bit more financially secure. Because I'm really big into education, so um, I just
It's a
think
good it's a good place for a business school professor to be, I guess.
yeah, and how often do you click on YouTube or Twitter or something, and there's somebody doing some banter about Bitcoin, or some banter about whatever investment thing there is. I'm starting to see more tweets of people predicting doom and gloom.
Mm.
That the world's coming to an end, and you should be doing this, or you should be doing that with your financial money. The economy is about to tank. The dollar's about to tank. Um, whatever, and for whatever reason it might be. And I don't think selling fear works anymore. Is one, but two,
Too many people doing it.
yeah, and I think people have been watching so many of these things that I think you really got to up your game. And I've thought about doing various things where instead of doing some of what I do at the Options Edge, talk about options. Um, and here's an investment idea, and here's how I'd structure an option trade, which is the bulk of the content. And then I'll develop a thesis, bullish or bearish, ripping higher, getting hammered lower, and then what kind of option strategy you should use to capitalize on that. The one thing that I wish everybody would do a lot better is a lot much more on valuation. So I
Mm.
don't care what financial news show that you're listening to. There's always a nice, and I forget if it's left brain or right brain, where they just sort of describe the story. So it's the conceptual part. Um, and they say because of that, buy the stock or sell the stock or whatever. Buy this investment idea, sell that investment idea. Um, and I would like just more work to be done on valuation, and maybe it's because I teach a class on valuation, to have that discipline of, like, okay, this is a great story, but the price fully discounts that story. I'm having a really hard time, wanting to own Nvidia, for example. Yeah, they're the leader of the pack and everything else, but I think the stock fully reflects the fact that they won. And so it's very hard to say, oh, is Nvidia going from 5 trillion to 6 or 7 trillion in total valuation? And so, I've been thinking a lot about how to sort of automate that process, because to do a proper valuation, can take a day or two or three, just depending upon the situation of
You know,
full-time work. That's why we have big Wall Street analyst house, um,
yeah, it's
dedicated to
interesting.
it.
You had mentioned a couple of stocks right before we went live today, and now that you bring up valuation, this is probably as good a time to discuss it as any. Um, I guess a couple of things that are important on the price to earnings front. If folks are looking at Nvidia, or Micron Technologies also would be maybe another example. Right now, if you're looking at a forward PE, they don't look expensive, but you think they're fully valued. Could you explain to folks how they need to think about this? That the valuation's not just a number.
Well, it's a PE multiple captures two things. One, it's the current earnings, of course, but it's an expected growth rate in that earnings over the next 10, 20, 30 years. And they've had a huge surge in sales, and rightfully so. They deserved it. I just don't see the growth in that for a while. Not necessary for a couple of reasons. The biggest one being energy. We're getting to the point where you put up a data center. That's terrific. There's nothing to plug it into. And that's
I have on my screen, by the way, the NVIDIA financials, that sort of high-level financials. So if we want to bring that up, and I'm going to blow this up just a little bit so
I think
people can see.
I just don't think we're going to have the growth there that the street is thinking, and that's why I think it's fully valued. And that's what we did year over year. 60 for next year, maybe. I'm looking for less than that, but and I'm still also looking for other players to come in. AMD has a nice competing product. They just don't have the programming platform yet, Coda. So that's Coda's really, I think, NVIDIA's moat. That it's the platform where you write all your software to make these chips do what you want them to do. So I just think we're kind of very fully valued here because of that. Because I just think the growth will still be there. There'll still be some growth. It's just not going to be anywhere near as fast as everybody thinks. And then it'll be very interesting to see how the industry responds 3 to 5 years from now when the chips have to be replaced. Because they're going to run these things hard and they're going to fry. There's going to be some new technology that you'll want to replace with. And, you just made a $50 billion investment in 3 or 4 data centers. And 5 years later, you got to replace them. Well, you're looking for an awful lot of revenue. Now, I understand revenue for a lot of these guys is growing pretty fast, really fast, like OpenAI and stuff. But is that like a step function, and then or is it going to be something that continues on? That's a bit of a question for me.
I worry as I look at these data centers, and it's not completely like for like, but I'd like to get your opinion on this. I remember the early days of the real steep ramp in mobile phones, cellular phones, as we called them at the time. We still do, I guess, to a degree. But in the early 1990s, having a mobile phone was quite uncommon. Yeah. Having a car phone was reasonably still uncommon, and then it became totally common. Now everybody has one, and wireline business has largely died. Now, when you look at, say, a real estate fund, a lot of the REITs you will have in there are companies like American Tower. And there were a lot of companies at the time that were building towers, and a lot of capital got thrown at that. It's a capital-intensive business. And it seemed like, this is going to be great because you literally are going to own the airwaves effectively. So you get to charge rent to have these towers up, and whenever this hugely growing business of people using mobile devices, they need to rely quite heavily on the towers that you have. That seemed nice, but the reality was, of course, that the technology was evolving very, very quickly. And so the technology on these towers was becoming antiquated. I mean, you barely get the thing up, and 2 years later, 3G, 4G, and so on. And so there's this constant upgrade cycle. Electronics degrade over the course of time anyway. Is that how you view the data centers? And if it is, what's the play? What's the best
Yeah.
way to get access? Is this picks and shovels, or is it the architecture, plumbing, utilities of the business? Is that a false narrative?
I don't know. Um, I'm like we're all going to use it. We're going to all use AI to do more things. Businesses are going to use AI to do more things, and there's going to be demand for it. Um, I just kind of feel like everybody's discounted a world that uh, may be here, but may not get here for 20 years. Now, uh, and there's a lot of
That feels .com-ish to
yeah,
me.
so there's
Pets.com.
something going on. I've read that, and I don't know if this is true, but I read that there's up to 30 states that are putting the kibosh on new data centers because the thing that is happening is they said, okay, well, we'll let you put up a data center. Here's your permit. And then the electric company goes and spends whatever they need to do to go um, generate electric power for you. And then they're spreading that cost over the total population instead of charging the data center for that monster capex. And we're
Mm.
starting to see tremendous pushback, I think, against that. And that's why places like Maine and others are saying, there's that people don't want
I
it.
think that pushback is warranted, don't you?
Well,
I
yeah,
mean, why should ratepayers have to subsidize this stuff?
yeah, I know. Well, yeah, you've got the everyday person subsidizing the billionaires. So, they should push back for that. You know what we used to do when I was doing power plants in developing countries. When there was a demand like this, then the capacity charge would get passed to the person using that power. So we needed this power plant to because we're going to provide power to a new mine going up someplace or whatever. That burden was not shared on the entire society; it was shared by or covered by the people wanting that incremental power, and that's what we should be doing here to protect that the average ratepayer. They should not be subsidizing big business in that process, and so. Um,
So if that creates a place to avoid in the form of the data, I'm not crazy about the data center trade. I don't like trading things that have massive and indefinite negative free cash flow, and a lot of the data center plays do have that. I'm not
mhm.
going to pick on any in particular right now, although maybe that's something we can take a look at. Um, Tucker D. Dog makes the observation: valuation seems like one of the few things AI should be good at calcing somehow. Um, I have you used any of the large language models or other AI techniques and seen how good or effective they are at things like security
I
valuation?
haven't, but I think the trick is building in enough in the prompt, and that's probably something I'm going to work on this summer. Is doing a lot more with AI and figuring out how to bring that AI into the classroom and how we might use it. I think I've used AI a lot to just like tell me the story, but I haven't
Mm.
had any luck with getting, here's the story of the company. This is what they're doing. This is why it's bullish, blah, 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 blah. Here are the risks. But turning that into numbers, I haven't had any luck yet. Um, and I think that the word there is the active word is yet. I think it will be able to do it at some point if I can figure out how to prompt it correctly. Um, and
Yeah.
there are a lot of moving parts, and then of course you would want it to be able to explain to you what assumptions it's making.
Mm.
This is what went into my model, and then because so much of valuation is like here's sort of like my base case. This is what I think is going to happen. And then if here's a situation where something goes wrong, we get a new competitor in the marketplace. What happens to valuation? and things like that. What happens in a recession? So you build some scenarios in there and try to put some probabilities around those scenarios, and then come up with an expected value. I mean, that's sort of the
Yeah.
approach that I have, and I can't. I have not had success yet to give me something that I would be satisfied with. Um,
I feel like the more you know, the more utility it can have for you. Number one, because you're more likely to catch out its
oh
errors. The
yeah,
other is that you will prompt it in a way um, that is hopefully going to identify some of the own mistakes. One of the things I've found about large language models is that they often give a definitive answer when none exists. Uh,
yeah,
and so I will often create prompts that ask it to argue one side and then also give the counter
yeah,
argument. So if it's when it comes to a sector, an industry, a name, I want the bull case, I want the bear case, I want the base case,
yeah,
and then I'll try to test some of the premises on which each of those resides. And this is why having some comfort or familiarity with the topic at hand is really useful for a user, because I've absolutely caught AI out on numerous occasions saying things that were just patently incorrect and reciting it back as if it was truth, as if it was not opinion but fact.
yeah.
So, and even things that were facts, getting the facts absolutely wrong. But I only knew that because I already knew them before I asked the question. So I think that's an important element. Black Muck Video says data accuracy. Yeah, need to point your agent to known good MCP servers, not just let it find its own source data.
Mm.
And I think that's what a lot of people have been saying: garbage in, garbage out. Yeah.
Yeah, I think that's right. But there's something that, that's frightening in all of this. Yeah, if you kind of think outside the square, is one is it's frightening. You ask it a question, gives you a wrong answer, and if you don't know what you're doing, um, you're going to make bad decisions, right?
Mm-hmm.
The worst one is it's acting like a life form. That how
Mm.
many people do you know that when they don't know something, they bullshit you? Well, it's just about everybody I know, right?
Yeah, I guess that's true. I
Right.
mean,
And I get this on
uh,
tests. I get
yeah.
this on tests. The kids have no idea, certain idea, some have no idea what, how to answer a question. And they will weave a story. And I don't blame them, because look at what they're hoping for, some partial credit points. And I don't
Mhm.
blame them for doing it, but, it's acting like a human being that it's like, I got to give them something. I don't want them to think I'm stupid. I got to give them something. So,
Yeah.
so anyway,
I will tell you. So, in a recent test that producer Jay, who can hear and see us but cannot speak, we gave an image recognition test of sorts to 4 large language models, and uh, 2 gave definitively wrong answers. Um, One gave a wrong answer and hedged a bit. I have to go back and double check
mhm,
this because it was now several weeks ago. And then I think it was Claude, that Claude, whichever one, however we
yeah,
pronounce this, I'm not even sure. I think that was the one that actually said, I
I d-
can't make out the image
mm,
enough to be sure.
yeah,
Um, which I thought, that's an interesting thing too, which is that humans tend not to admit that they don't know
yeah,
something. But I have found in formats like this, right? So you're on camera, you're being asked, and if you don't know you're almost always better off if something's going to be preserved for posterity. I think that one of the reasons that humans quickly give some BS answer is because they're hoping they can just put the whole thing behind them and it'll all be long
yeah,
forgotten, right? But if you're doing something like appearing on television or if you're recording something for posterity, it's probably not a good idea to BS.
yeah. Then people will shoot arrows
Something
at
that
you
something that
for weeks to come.
well, I think AOC figured this out when she went to Europe and started getting asked questions on some issues where she clearly had no familiarity. Because, of course, what ended up happening was that has now been preserved for posterity and replayed very
Yeah.
painfully for her, I'm sure, again and again. And so I think it's better, and most humans, if you're asked in this kind of a context, you should just say, I don't know, or I need to look into that, and I'll get back to you.
Yeah.
Or, none of us have perfect knowledge. One of the things, though, that you had also mentioned as we talk about valuation was that you were looking at some healthcare names,
Yeah.
and I thought this was kind of interesting. Maybe we can take a look.
Well,
I'm just going to show a chart here if I had. Is
yeah.
this the one I wanted to show?
United Health came out with their earnings
Mm-hmm.
and before the opening today, and the world liked what they had to say, and I think what people are
Look at
starting
that.
to think based on this result. Just to give you an idea, same quarter last year they made 685 a share,
Mm-hmm.
and this quarter they reported 690. So um, it looks like their whatever their earnings problems were maybe under repair now, and
Mm-hmm.
and turning around. Now to give you an idea, the company I think has in their best years made $22 a share, $23 a share year over year, and
Let's
I
take a
think
look.
they guided to about 16 and change for this.
33.38 a share they made full year, calendar year 2024.
Okay, so that was a little hard. So that one's anomalous on the upside. Um, and
Yeah, it was $10 lower the prior.
yeah, it says 10, and then and so that probably doesn't make a lot of sense. Their normalized earnings was probably in the low 20s per share.
It's a good number
And
even at the current share
that's a
price.
very good number. Now the revenue didn't change much. I think it's up 1% or two, which means they're getting everything right sized now.
Mm-hmm.
Um, and so I think the share price is probably bottomed in here. I'm looking for now going forward surprises to be on the upside, um, and and so forth. So I think their situation is looking a lot better. Now the question is what is their PE ratio? I think I had it up here before.
Well, if $20 is the number for fiscal 2027 for next year, that puts them at 17 times,
17, and so they
right?
they guided to 16 and change. Let's 1685 or something. I forget the exact number.
Mm-hmm.
So maybe a low 20s. I think that is very reasonable in this market, especially if surprises are going to be to the upside. So
Mm-hmm.
I'm looking for this stock on a valuation basis to move higher. And I like to do a lot of work around valuation, especially when I think about what I'm going to buy, because um, I want to know that if there's one or two bad quarters, that the long term value is there, and you're gonna because anything can happen in the short run, right? Um,
So, yeah, it's interesting you mentioned United Health. So, United Health had a couple things that are worth noting, and probably has something to do with the company's sort of leveling out their business. The prior CEO had retired. They brought in a new one,
mhm.
Andrew Whitty. Andrew Whitty I think that was his name. Let me double check that. Yes, Andrew Whitty. So he had come in, and he was expanding aggressively in some of these programs that depended very heavily on good actuarial work,
Yeah.
on the payouts for certain classes of insured, and also the reimbursement rates
Mhm.
on that same group. And um, they were much more aggressively pursuing some of these businesses than other managed care
Okay.
companies were. And the byproduct of that was when they got a little bit upside down, it hit them hard. Then there were some other issues about billing practices. In fairness, Mark, you and I have we've been hearing about this company for a long time because when you and I worked together at CRT Capital, you may remember that our head of research, she used to love this company,
Yeah.
Cheryl Skolnick.
Yeah.
So when Mark and I worked together at CRT Capital, Cheryl Skolnick was the head of research there. She has a PhD. She actually ended up working for United Health for a couple of years. She was an advisor to the CEO. So for the better part of almost 3 years, starting in 2021. So we've been following this company for a little while, and these were not immaterial growing pains that have been experienced, but this is trading at a big discount to the multiple that it has previously enjoyed. Here, what I'm showing is, and let me get rid of this price. I'm going to hide that. Okay, so this is the multiple of the healthcare select sector index overall. So if you were looking at ETFs, this is the index equivalent of XLV.
Okay.
You can't go out and buy IXV, but it's the underpinning index on which XLV itself is based. And what I wanted to illustrate for everybody is that if you will notice that the multiple for this as a group is probably not far off of its mean. This is a 10-year number, right? So it's trading around 8, and this is trailing, right? So we're looking at trailing earnings, 18, 19 times trailing earnings, and generally our expectation is that healthcare should grow probably with the population, right? In fact, healthcare spending has vastly outpaced it. So I think it's an interesting spot to be when one considers where the broad market is in terms of valuation.
Yeah.
So you like United Health, and how about Humana? They're kind of kissing
Humana,
cousins of a sort, I suppose, right?
I've listened to their ads for most of my life. They're out on the West Coast, right?
This is another one of the ones that's been hard hit for many of the same reasons. Look at this. This thing is right back of basically where it was 10 years ago. Isn't that amazing?
That is so painful. You think you've got a good stock, it's growing revenue, it's growing earnings. The wheels fall off and it erases 10 years of patience. It tells you something about the...
But for a patient investor who was not involved,
he gets a chance
might now be the time to get involved.
Yeah, that gives them a chance to get involved. And, it does say something about, that maybe you don't buy and hold forever, but you buy and hold hopefully long term. When I buy a stock, I'm hoping to hold it a minimum of a year so I can at least get long-term capital gains treatment. But, it's... it
well,
just
a lot
tells
of
you
people...
there's very few things in life you can buy it and forget it. Even Charlie Munger said that Berkshire Hathaway fell 50%, I think, 3 times over his lifetime.
Well, this thing fell more than 50 because it fell from 500 and what was the highs in here? The highest price was 563, and it fell to $1.65.
Yeah.
Can you imagine? I mean, that is amazing. That's a 71% decline. Now there are dividends here. So as I look at this, I think people might want to consider this as a space. You could look at XLV as an ETF, and or you could look at these individual stocks. I kind of prefer XLV. The reason I prefer XLV is that I have this where there's smoke, there's fire kind of thing.
Yeah.
And, there were some concerns about the billing practices, what they were billing Medicare or Medicaid. And to that, my thinking is you want to start looking at things that have been beaten up. It seems like they've turned the corner, all promising. It's trading at a more attractive multiple to the broad market. But just diversify is all I'm saying. Don't throw 5% of your portfolio into United Health, but recognize United Health is an important driver in XLV. So maybe pick up a little XLV And if Humana and United Health truly are coming out of the woods, you will get exposure to that.
Everything.
But if they aren't, it's not going to be the end of the world.
Yeah.
So here's a question for you.
Yeah.
Do you have an opinion on UAL, United Airlines, going into earnings?
I think the number is going to be good. Everything that I see is they're having no trouble filling seats.
Mm-hmm.
Now the big question, of course, is going to be the guide. So I think they'll report a decent number. I haven't flown for about 6 or 9 months, so I don't really know if prices have gone up. Have seen prices gone up much? Do you know?
They seemed a little pricier to me. I actually just booked some travel to New York, but I will confess that the way, it's funny, and United and Delta both benefit on a relative basis compared to the Loves and JetBlues of the world because they have more business travelers. Yeah. And the travel that I'm speaking of is business related. Yeah. And it's interesting because, of course, if I was booking tickets for my family, I would remember probably to the dollar what those tickets cost. Mm-hmm. But actually what happened was I was booking a business trip, and like many companies, our company uses one of these systems. So if you're going to travel, you log into the system and says, where are you going and when? Reason for your travel. When did you want to leave? When did you want to go? And then the system actually goes and hunts for the hotel you're going to stay in and the airline. So if I have preferences, so I stay at Hilton's a lot. I'd say, I'd rather stay at a Hilton, and I'd rather fly United or Delta because those are the airlines I use. It will choose those. And then it just gives me a bunch of prices. Here are flights that are okay with you. Now, I don't know how many flights there are. And I noticed that I'm not allowed to fly business class. Because I went on and I was just like, okay, so it capped me out and I can take, economy plus or whatever. But I have no options, right? So I said, I want to fly direct. I want to leave on this day. I want to come back on that day. And then the system just gives me a bunch of options, and I just choose whatever seems to be the most appealing one from a time perspective. Whereas if you and I are traveling for ourselves, what do? I mean, we're very cost conscious, I'm sure. I took 4 people to Hawaii over Christmas. I was, paying very close attention to what those things cost. So, unfortunately, I should know, but I don't think I could tell you within $100 how much that ticket costs because I was only given a couple options. I was like, that one fits best. Okay, just do it. And it doesn't come to me. I didn't even have to use like a corporate credit card to do it.
Yeah.
I just go in the system and pick that. And that's kind of an interesting thing because really that's probably where you could probably get a lot of data. I bet you those companies for business travelers, because business travelers don't get full visibility for the same reason. At bigger companies, you don't just get to pick your own stuff. They have all kinds of things that they're doing to optimize their travel expenses, and so you get limited options. I'm very curious about that.
Now, while you were doing that, I did a quick search, and I was looking for revenue per seat mile. And it took me to Fred.
Oh, yeah.
The Federal Reserve Bank of St. Louis. Unfortunately, their last data point is December 2025. So I'm wondering if Bloomberg has...
Back when crude was $55 a barrel for WTI, that's helpful.
They have they say their next data release is May 1, from Fred. But I don't know if there's something more advanced. In Bloomberg.
Well, the ARPUs are going to be one thing. That's only going to tell you part of the story because, of course, what we're really interested in are the expense implications. So it's not ARPUs. Let's see.
I'm just kind of interested in are they keeping up?
Oh, no, not PRTU.
And then I'm reading a lot where airlines are upping their bag charges.
Oh, yeah.
And sort of the miscellaneous stuff that's hitting you with the nickels and dimes that can add up.
Oh, wait a minute. It's not ARPUs. ARPUs we usually use for telecoms. You're thinking of the PRASMs, right?
Well, I don't know. I just got...
Average revenue per seat mile.
Yeah, average revenue per seat mile, yeah.
Um,
So that's what I put into the search is historical airline revenue per seat mile. Um, eh, and
what is the code for that in? Um, you know what? Let's do this. And actually, so FinWest was talking about Delta responding pretty well to their numbers. A quick thing about Delta. So first of all, Delta has the strongest balance sheet of the major carriers,
yeah,
um, and Delta has something that other carriers don't have. This is not a cure for high oil prices, but they do own a refinery that they bought from Phillips
yeah.
66 about 14 years ago or
But
so.
it locks in
They're the crack
their
spread.
crack spread, yeah, which is
Mm.
blew out. So that means
Yeah,
more
that's
money
right.
for the refiners. They're at least internalizing that shock,
Hmm.
and they don't get hurt by it. They're just getting hit by higher oil price.
Yeah, so this is the crack here. This should give some sense of it. You can see, and actually, I should just do a 1 year because I think that's going to be more illustrative. So, oil prices have gone up, but as Mark was just pointing out, this is the crack spread. And you can see that this has just gone through the roof. So, the numbers would be better for Delta on the back of this than they would be for other airlines because most airlines don't own refineries. Delta does. So, they still have to pay the feedstock cost of crude prices. But and the thing is that this is like a natural hedge. I guess the point I would make for people is think about this. It does not matter whether they are providing jet for all of their planes. They're not, right? So commodities are going to be relatively local. But what they are benefiting from is the spread differential because their own refinery is going to make that wider margin.
Yeah,
So
that's right.
that's, I think, Fly Tucker D Dog says Fly Q FLYYQ if no government bailout, or maybe if a government bailout. Let's see here. Oh, what do we have here? I think we will seven-figure measures. I think we will see some consolidation in the airlines. JetBlue seems ripe for a takeover. You know, it's interesting. Didn't we just refresh my memory? Didn't we just have a situation where an airline merger was nixed on antitrust concerns? Why do I have that in my head? Am I wrong about that? Yeah. So, yeah. So let's see.
Yeah, and there's
See
this talk
air.
about UAL merging with American, and I think that's just uncalled for.
Yeah.
Um,
Um, yeah. So yeah, that the interesting thing is, I mean, this is such a it's a difficult business. Actually, going back to the Cheryl Skolnick times, we were just talking about United Health. You and I did a lot of work, and we had a lot of people who did a lot more work than you and I did at the time on American Airlines. Remember that
yep,
the American Airlines bankruptcy back in whenever it was, 2012 or
yeah,
so, 2012, 2013. It's in that neighborhood. Um,
yeah. We created synthetic claims.
yeah, that was
That was a
really
that was
interesting.
a very interesting trade.
Unfortunately, they didn't let us do it. Um, we were supposed to. So this is one of the things, by the way, for anybody who's watching, and you may not believe that, you're thinking, oh, options are an obscure backwater, and does it really matter? Sometimes it matters a lot. Mark, would you like to talk, if you happen to remember any of the details about why understanding options is so important in special situations such as the American Airlines bankruptcy, and I'll try to fill in the parts that I remember because it was, after all, almost 14 years ago.
Um, I don't really know where you're going with this.
Okay,
So,
so maybe I'll refresh your
all
memory.
right.
So when American Airlines filed for bankruptcy, at the time, AMR was the ticker symbol. American Airlines had two companies. They had the operating company and they had the holding company. And when they filed for bankruptcy, they had what were called single dip claims and double dip claims. Mark, could you just articulate for everybody the difference between a single dip claim and a double dip claim in the context of a company that has both an operating and a holdco?
I remember going through this in excruciating detail and us putting together,
we had a very complicated model.
A complicated model for claims. And so, people were owed money by American Airlines or the parent company, and they would get different payouts.
So the deal was, so just in simple terms, for those who don't know, when the company was issuing debt, they could make it so that the holding company owed that debt. They could make it so that the operating company owed that debt. Or they could make it so that both were jointly and severally liable for that debt. If both were jointly and severally liable for the debt, then that was a double dip claim, meaning that the debt holder could lay claim to both
entities.
And single dip claims, obviously it would be one or the other. So when the company was restructuring, there was all of this debt. And it was, I have to give credit to the CRT Capital research team, were just phenomenal. They had the serial numbers for all of the tugs at the gates. They had everything.
Yeah.
It was just amazing just how much work they had put together. It was like a team of 5 people. In any case, the gist of it was this. They were going to file for bankruptcy, and there was going to be some measure of recovery, and everybody's trying to tally up the assets. Very complicated business, as you would expect. At that time, U.S. Air decided that they wanted to buy American Airlines. And so U.S. Air and American Airlines were going to merge. And the question became, okay, well, if U.S. Air, some new company is going to come out of this, how does everybody get satisfied? And so basically you had this waterfall of liabilities and debts. The single dip claims, the double, kind of think of it as the double dip senior debt was at the top, right? They would get paid first. And then as you went further and further down, depending on how much recovery there was, then people further down the waterfall would get some kind of recovery if there was any, right? And in the merger case, what they said was, okay, well, we are going to repay all of this with NewCo stock. The newly merged company stock was going to be how this all got satisfied. And they needed everybody to go along with this. And so at the time, it kind of looked like it looked like the equity, as is often the case when companies file for bankruptcy, that equity might get nothing. But to get them to go along, they said, well, look, here's what we're going to do. If you're an equity holder in American Airlines shares, we are going to give you 4 Asian options on NewCo shares, which NewCo shares didn't even exist yet.
Yeah.
So you have U.S. Air on one side, the American Airlines on the other. You're going to create this melange, NewCo stock, and if all the double dip claims get satisfied, and if virtually all of the single dip claims get satisfied, then if there's anything left over, which they figured meant that NewCo shares had to be above $17.50 a share or something like that, then the equity holders will get 1.7 shares of NewCo stock struck, call option struck at the average price of NewCo, whatever.
Yeah.
And amazingly, and so you and I did the work, and we said, well, even if it does not prove to be enough, that option has value. And this is a highly volatile enterprise, right? Mm-hmm. So we figured out the shares were trading in as a 5-letter ticker in bankruptcy, and you and I figured out that the options component alone was probably worth about $3.50 a share. You remember that?
Yeah, you remember. So I do remember that, but I got to tell you, you remembered this stuff so much better than I do.
Well, I mean, this is one of those things that it just sticks in my craw even to this day because we went to. I'm not going to mention his name. I will mention that he was the former head of equities at Morgan Stanley, and he was our new boss. Remember, he had just
Yeah.
started. And I went to him and I said, I want to buy $5 million worth of American Airlines stock, which was trading in bankruptcy. So that would have meant, by the way, quite a lot of stock because it was trading well under $1.
Yeah, it was like 23
And
cents.
yeah. And I said, we want to buy $5 million worth of this because we think the shares are worth at least $3.50 a share. So by our work, we should make 15 to 20 million bucks on this alone.
Yeah.
Assuming we don't hedge. It's like
Yeah.
15. But I said we can hedge it if we want. And I remember he said, well, maybe you can just sell that idea to some of our customers. And I was just incensed. I was apoplectic. I said, why? Why? If I could find dollars lying on the ground, are you telling me I can't pick up the dollars? What I can instead do is ask someone to give me a penny to tell them where the money is.
Yeah.
I just did not know what to make of that. You may remember I left the firm almost immediately thereafter. I was like, that's it. I'm done.
They were not serious. They did weird stuff about how they risked capital.
They did it all on their treasury desk.
That's
like-
where, yeah,
they
that's
used like
right.
a couple
That's where
$100
the
million
lion's
bucks for
share
that.
was. Yeah, but by far, I think
Um,
90% of their capital was on the treasury desk.
Yeah, I mean, they were, in fairness, for those who don't know, they were principally a bond shop, principally a fixed income. Look, I mean, it was in the name, credit research and trading. They mostly traded credit, but this was the biggest sitter I'd ever seen. Now, here's the horrifying part. Do you know where those shares actually went?
Yeah, like
you remember?
15, 18 bucks a share.
I think it actually got to.
something like
I
that.
think it actually got to 34
Oh.
adjusted because each of these was worth more than, it was not share for share. It was like 1.7 shares in Newco.
Mm. Yeah, I just remember I quit
stupid
following it
trade.
at that point. When
Well,
it was in the teens. It's like,
I
okay.
remember thinking that it would have been a 34 bagger.
Yeah.
That's what I remember. It was a 34 bagger. And I said, my God, we would have made $100 million bucks.
Yeah. Would have been nice.
Horrible.
Yeah.
Horrible. Instead, we got Bupkis. Bupkis bucks.
Yeah. Life goes
This
on.
is the reality. It's one of those funny things. I mean, I guess it's true for life. It's true for business. It's true for our business. Everybody was running scared back then. I mean, we'd all been so beaten up in the GFC.
Mhm.
Everyone was just scared. I'm not going to use the profanity that normally follows that, but wow. That was an interesting time.
All right.
Anyway, so United Health, Delta, United, I think United Airlines. So we've spoken about United Health, we've spoken about United Airlines. You think it's okay to be long this one going into the print?
I do, because the stock has been beaten down. Now, if we look at the price of oil before this happened, what was it, about 55 bucks?
That was the lows, and that was West Texas
And
Intermediate,
so
not
let's call
Brent.
it
That was
65
the
cents.
mid-December lows, 55
And then
bucks
it
a share.
kind of
Yeah.
hovered around 100. That's a, quite a jump.
Mhm.
These guys used to hedge going out 6 months to a year.
Southwest did. Mhm.
I don't know if they did because I haven't gone to look through their disclosures to see if they continued to hedge. As a matter of business practice. Like I said, I think the numbers they're going to report are going to be okay. They're going to surprise on the upside. Because they're still filling up planes. People are still doing stuff. They have no problems there. But I think it's how they're gonna guide is gonna drive what the stock does. And this is if they think they're gonna say, hey, we think this goes on for another year, whatever, or we can't survive at $100 oil prices. I mean, that's an exaggerate. our ROE is substantially damaged at that oil price because we can't pass the expenses through. I'm wondering if what we're going to see the airlines do is just put energy surcharge on plane tickets. So it's like, here's our
We see
normal
that in a
price,
lot of.
and that kind of absolves them and says, hey, it's not us raising your prices. It's just the way the world is.
Well, here's one thing I would just point people to, right? Which is that back in 2023, and early 2024, it looks like they had margins of somewhere between 5.5%, 6% ish, right?
Yeah.
And that was with $77 crude. That's not, look, 98, which is where we find ourselves right now in Brent, is not immaterially higher at 98 than at 77. But we're looking back to 23. We're going back 3 years now. Prices for a lot of things have risen.
Yeah.
They have probably risen at 5% a year. 5% a year translates to what, 17%ish.
Yeah. Compounded.
So over the course of over the relevant period, 17% on a $77 barrel would get us to 90, and we're at 99, 98, 99.
Yeah.
So, can these companies operate profitably?
There's no
With crude
question
here?
that they're going to make money. It's
Yeah.
whether or not they're
Yeah.
going to get
It's how much they're going to
it's the ROE that are they going to be up there in that double digit range? Or are they going to be sort of like low single digit?
And the street's looking right now for 4.4% for the full year. That still and I guess that's the question. Like, is that a believable number, or do people subscribe to the idea that that could be true? I think 4 to 4.5% adjusted net income margins is a believable number.
Yeah.
I think 11 times full year earnings, maybe a little higher than the airlines have traded recently. How's this one traded? Let's see.
They tend to trade at 8 to 12, I think.
Yeah, so that's a little on the high side, but not really, actually. Look at that. So the historical average, actually, for this one is United's historical multiple. They're saying it is 15. That's what Bloomberg
Yeah, that
has.
sounds too high.
It does. I always felt like they'd been trading, 8, 9 times.
Yeah.
Um,
Oh, for the past 2 years, that's a little strange. Yeah. Hit the 5 year. Right.
yeah, let's go to
see
5.
if-
Yeah, let's get a little more history.
Yeah.
It's got to be a lower number. There, yeah, it is.
A little bit. But
Still
not-
higher than I
still
would've
higher than I
thought.
would have thought. Yeah. So
Yeah, I mean, it's had a little bit of a move. How much of a move is it implying right now? It's the
well, maybe it had a hangover from the lockdown.
yeah.
Because that really
5.4%.
distorted the economics of these companies.
I suppose. I only wish. I mean, I will say, because the whole space is traded well off of Delta's earnings. When was Delta? They were the first report that was on the 8th. Is that right?
Mm-hmm.
Actually, it's given back most of its gains. It looks like.
Yeah.
Let me just double check that. I think Delta was on the 8th. Let me double check. Yeah. Okay, it was on the 8th. And it's given back all the gains since then. Interesting. So if you were looking to get long, now would certainly be a better time to do it in that sense, that everything it had, well, not everything, but a lot of the gains it have since given back. And it's not far off of where it was it's basically right where it was on the 25th of March.
Mm-hmm.
So, from that perspective, not the end of the world. You're getting it at a big discount to where it was at the beginning of the year. Yeah, I think it's okay. I will tell you that my own thinking of late has been, I like looking for some of these sort of longer term, steady Eddie plays that are trading a little cheap. Dow Jones dividend index names, for example, still yielding 3%. I think that's kind of an interesting area. Trades probably as a group at about 18 times versus where are we?
Yeah,
23 for the
that's
S?
not bad. Yeah,
Yeah,
the airlines are nice business now. They were terrible business for a long time. because it was just
Mm-hmm.
too easy for new airlines to come in and um, cherry pick the profitable routes by the big carriers. So they'd find where the
Mm-hmm.
biggest margins were. Then they'd go like, we're going to form an airline and we're going to plop a 737 right into there. And then they throw a monkey wrench in the whole the profitability of that. So everybody else has to lower their prices, and so the profitability goes down for the big guys. Then you have a recession. Then the little guy goes out of business. The big guys have a near death experience, and then there's a big recovery, and then that would happen over and over again. And now that's not really possible because the airlines have figured out that what you do is you go by the landing slots, and if they own the landing slots, um, then these Johnny come latelys can't come in there and stuff up um, your economics.
Mm.
And so
Yeah.
they really act like oligopolies now. Um, and so as a business, if you're looking at it from that point of view, their earnings are going to be much more steady going forward, and as they have been for, I want to say, what was it, 10, 12 years. I remember Leon Cooperman being on CNBC saying he loved United for similar reasons. It was trading at like a 10-ish PE. This is before COVID.
Mm-hmm.
And um, So he liked it. Oh, you're back over here to MicroStrategy.
So I can't,
Strategy Inc.
we've sort of, well, we've been talking about a variety of topics now for the past hour, and we're going to be wrapping this up pretty shortly. But I mean, you are a crypto guy. You own these names. You own crypto. You mine for this stuff. You teach on this stuff. I look at this right here, and I say, okay, looks like we might be getting into territory where we could potentially see a bearish to bullish reversal.
Reversal, yeah.
Um, and I might be front running it a little bit. Am I?
Um, I don't know. Is the short answer, because if you look at how it traded, just let's see, from what is that, October to December. I think they
Mm-hmm.
call that a bear flag. You go down, you bounce, and then you get hammered. And a lot of people are saying, well, we just got another bounce here since the turn of the year into where we are right now, and we're about poised to take a beat down as we get rejected from the 200-day.
Mm-hmm.
Um, that's
Well, this
possible.
is the 150 that I got up
The
here. Let me
one thing
put
that I
the.
find interesting, though, is that what was it? Morgan Stanley came out with a version of the Bitcoin ETF,
Mm-hmm.
which has been wildly successful. They've got what, 15 trillion under management or something. Uh,
They and BlackRock
yes.
are the
So they
behemoths.
go, customers put 2, 3, 4% in there. There's a lot of potential pent up buying. MicroStrategy has bought $3 or $4 billion worth the last 2, 3 weeks. They've been
Mm-hmm.
paying for it with largely preferred stock, but a little bit of common, but mostly
Mm-hmm.
preferred stock. So um, there just seems to be all kinds of demands, and I also the something that is new is money is starting to go into IBIT, where
Mm-hmm.
that's been very quiet for the last 3 or 4 months. Money just not going into BlackRock's ETF. And so now Morgan Stanley has one that's wildly successful, a lot of money going into that. It just seems like there is some fundamental reason why maybe we got a bottom there, and Bitcoin, and we could start marching higher again.
Yeah. I well, I kind of hope we are for the following reasons, which not least of which is that has been your point for years. prosecuting wars is expensive. Prosecuting wars is inflationary.
Yeah.
We can't seem to stay out of them. God help us.
Yeah. Well, it's ever
Um,
since World War One, is the country's been basically at war for all but, I don't know, 8 or 10 years. It's tragic. There's something fundamentally wrong with us. It's like that Keanu Reeves movie, that the day the world stood still. Remember that one? I don't
mm.
know if you remember. Well, so space aliens came here to say we got to wipe out Earth because you guys are stuffing it up too bad. And so we got to wipe you off the planet and reseed this thing.
Well, you and I discussed PIC a couple episodes ago, payment in kind.
Yeah.
And it occurred to me that the dollar is like the ultimate payment in kind. We issue debt, we print more money. It's like it's more IOUs to pay the IOUs.
Yeah.
It's like the ultimate PIC story.
It is. It's like
And it accelerates when we go to war.
yeah. And the president is asking for like $1.5 trillion for defense for the upcoming year. I go like, everybody's gone mad. Again, and it's being discussed seriously. Um, and he, Trump had his pluses and his minuses, but the thing that scared me more than anything else when he ran for president um, was that he's a real estate guy, and real estate guys try to borrow as much money as they can. It's their motto is other people's money, and
That's governments too.
and it just be yeah, it's government's thing. It's other people's money, and they don't care. There's no discipline. I don't think. I always thought the world was the economy would crap out once we hit $1 trillion deficit, and it's like they just yawned at it. And now,
I mean, it blew past $1 trillion deficit and went straight to two without batting an eye. I mean, it was.
yeah. And it
I
just
think
boggles my mind that the rates stay as low as they do. That for whatever reason, market forces don't push interest rates up much higher because you don't get a real return after tax by owning treasuries. And so I
mm,
don't understand why anybody would own them except for you're owning them to hold them until you're trying to figure out what you really want to buy. Right? It just equities make so much more sense, and maybe that's probably why um, the
is
stock
that
market
why
is
the
as
S and
overvalued today as it ever has been in the history of the country.
Do you think that this is the reason why? And this is something I've been observing lately, that the rebounds are as fast or sometimes faster than the drawdowns. Because take a look at this rebound that we have had right
I know
here.
that's just crazy when you think about it.
Um, this is remarkably violent. It was so if you take a look at the peak to trough drawdowns that we experienced this year. So let's see, where was the highs? Here, give or take. So we had a 9% drawdown over 39 sessions. And that was in turn followed by an even bigger, and this is nominally bigger,
Hmm.
by a 12.3%
Yeah,
upswing in just 13 sessions.
yeah,
This is, I mean, that is a profound move. And I think it's a worrisome one because I think that's probably going to be coming up close. Because I just realized we've been taking up about an hour and 15 minutes of everybody's time. I guess the short thing we would leave everybody with is that whenever we talk about equity valuations, and the reason that we look at things like United Health and Humana and healthcare, and we look at the Dow Jones dividend index, is because the alternative, which is to own treasuries or some kind of fixed income asset or to keep your money in dollars, that's surely going to lose.
yeah,
That's the thing. So the alternative is if you invest in equities, you're taking equity market risk. But if you keep your money in cash, you will lose
hmm
purchasing power.
yeah,
And purchasing power once lost, it's a ratchet function. I think it was on Grant's Interest Rate Observer or something like that I was listening. He said it's a ratchet function.
Yeah, the price just
Purchasing
goes up.
power,
It never comes back down. It's just price.
Purchasing power is never restored. And I think he actually went back to 1953 or so, or 55, when he said that there was actually a negative inflationary print. And nobody got upset about it back then. It was the 50s, like the early 50s. Because, but it was, that just doesn't happen. The dollar won't regain its value. It's just going to continue to lose it. And maybe that's as good a place to leave it as any.
Yeah.
So I will allow you to go back to listening to the complaints of the students regarding their grades that you will not bow to. They're entreaties for better grades.
That's it. We
Will
don't
go
negotiate
unanswered.
grades.
And I look forward to doing the next one.
Okay.
Same time, same channel.
Yeah, great.
For all of you watching, thank you very much. Like, subscribe, notification bell.
Right.
And for those of you who participated, we thank you for that too. We'll see you soon.
Thanks, Mike. Bye.